Welcome, everybody. Welcome to our post-Christmas, post-Hanukkah, in the middle of Kwanzaa holiday edition of Breaking News so you don't break the bank. Welcome, everybody. Merrill Chandler here, your host of the Get Fundable podcast and your guide to the Get Fundable universe. And we got a couple of things we want to cover today. Kind of some news. Remember, I like to stay out of the political arena. I want cold, hard facts, cold, hard cash. So, and how it affects our fundability. There's a couple of things that are going on right now that may actually end up closer to home. What I mean is, a big business is making a comeback here in the post-COVID era. First of all, the stocks are on the rise because of several announcements made by the administration that is actually focusing COVID response and COVID mandates and COVID issues to the states. In fact, Biden was quoted as saying there's no longer federal solutions, and we're sending all things, whether you're open for business, closed for business, what shelter in place, whatever it is going to be a state issue rather than a federal issue. Now, a couple of things are a result of that. First of all, there's likely no more federal stimulus checks going to be coming out. And more importantly for me is that there are a number of big business, Fortune 500 companies who, Delta in particular, Delta Airline requested that the CDC lower the folks who tested positive but were asymptomatic, meaning they weren't showing symptoms, that they be quarantined at home and not going to work for, it used to be 10 days, and now the CDC has made that for 5 days. So business owners, entrepreneurs, it's going to go case by case, state by state, but just remember, always be safe, be careful, be kind to folks who have differing opinions. We're in this to be fundable and how to leverage our relationship with banks so that we all have the opportunity to continue to take down business loans, business lines of credit, the best mortgages. Speaking of mortgages, U.S. home prices on the Case-Shiller index surged 18% October over last October. This October from a year ago, 18%. So it's been crazy in many parts of the country. One of the things that's driving, there's several things driving it, of course: limited inventory, a 2.66 30-year fixed rate. This is crazy talk, right? Next, they're going to be offering like auto dealers do. It's like zero money down on approved credit, OAC, right? This is insane. But there's also attribution to literally millions of people who said, well, because the pandemic, it keeps stretching out over time, they're like, well, if I'm going to be stuck at home, I want to be in a bigger house. And so they're entering the marketplace, and rents are, in most places, rents are higher than mortgages. So if they can even barely squeak out through their if they're barely fundable, they're choosing now home ownership over renting. And so we've got all this perfect storm of so many crazy things going on here, you guys. So I just want, those are not related, but they're related, not related, right? So big business is still pushing for to do self-policing on how they are treating their teams and employees, to make sure they have internal policies for for testing and vaccinations, or whatever their end game is for protecting their people. So fewer days required to quarantine if you're test positive but don't have symptoms, and everything's being relegated to the state. All right, so a lot of stuff going on. Now, next, this is the we saw this coming. But remember how I talked about video conferencing, etc. Well, there are a couple of tier 2 banks, not tier 1s yet, but a couple of tier banks that are opening smaller branches in more micro areas. They're opening smaller branches with video tellers, and one is even being tested inside. It's a joint venture with a coffee shop, not a coffee shop as in like a diner, but like a coffee boutique, right? So you can start doing your banking while you have a cup of joe, and you're able, the bank tellers are video tellers. So it's live. It's not an ATM. It's live. They're handling things with their computers on the other side of the video call, but you are now talking to a video instead of a live person. So many things are going to be changing this. We've already discussed in previous episodes where some experiments for Citibank was a big one. Bank of America was also in this play, where they said we can't get out of the branch business. Neighborhoods and communities are how we continue to build relationship with our depositors, right? Which is the likeliest way to go from someone becoming a depositor to using a credit product, credit cards, home loans, auto loans, etc. So we're now seeing this test is going to see, are there going to be, what kind of relationship does relationship building, the metrics improve with video tellers in communities, or do they need human live in-person human interaction? More on this as things come out. So you guys, we're heading into 2022. 2021 was crazy, and I see a lot of positive things happening for Fundability. One of the things that I want to spend our final few minutes on is that of cryptocurrency. I get a lot of calls, boot camps. I get a lot of questions like, so what about cryptocurrency? How do I be fundable with cryptocurrency? Okay. And I want to make sure that we all understand cryptocurrency is going to continue to be like this as a currency. Banks are using it. Some banks are using percentages as security, like you can if you've got a trading account, right? You've got stocks that you purchase. You can use the percentages of those to back loans, etc. More and more banks are moving into using cryptocurrency accounts as collateral, securing certain loan types. But what I want to focus on is the fact that it does not matter what is backing a loan, whether it's your personal reputation, your borrower behaviors and reputation, which we call unsecured, or it's backed by US dollars, backed by gold, backed by trading accounts, or stocks, bonds, or cryptocurrency. It does not matter what is backstopping or securing a loan or a margin account or otherwise. What matters are your borrower behaviors. So they're not measuring how you use your cryptocurrency, because no banks right now are actually using cryptocurrency, right? None of the tier 1, tier 2 banks are using cryptocurrency as a means of trade. What they're experimenting with is using cryptocurrency accounts to secure these loans or secure some loans, right? So I just want us to understand that borrower behaviors, how we pay back the loan, is more important. How we use a credit card or credit line, even if it's secured by anything, including cryptocurrency, how we treat that. The 40 borrower behaviors we study in the boot camp. Everything is based on our borrower behaviors. It has nothing, let's be clear, has nothing to do with what's backstopping the loan or line of credit. Everybody with me? Fundability is not changing. In fact, that's been one of the questions that I've been asked on a couple of panels that I've been on this last month. And one of the big questions was, hey, what about this cryptocurrency thing? And that my answer to them is the exact thing that I'm sharing with you, is that how you treat a lender's money. Let's say it even moves into cryptocurrency where they literally give cryptocurrency account trade. Let's say that happens in the next year or two or more. It doesn't matter what what type of currency, what type of instrument they're giving you. It's how you pay that, how your borrower behaviors regarding it. If you're given let's say you're given a $50,000 cryptocurrency line of credit, well, the rules still apply because it's borrower behaviors. It's the human behavior behind it that makes it risky, not the type of currency that's being used or the type of account that's being used. It's our behavior, and that stays strictly human. And FICO and lender algorithms have been measuring us for decades about what is risky behavior and what is not. It is irrelevant what type of what the means of currency, the means of trade, that it does not matter what type is. If a lender gives it to you, they're going to be measuring those borrower behaviors with their internal performance data. FICO will score you based on the same performance data that we have right now, because that data doesn't change. So if you're part of the Funding Hackers Q&A, we will see you in just a moment. If you're not a member of the Funding Hacker, come to the boot camp. Learn all the things that we're talking about. Love, like, share this with anybody who might be interested. Get this out into the world so that people know how to invest better and take care of their own fundability. This is Merrill Chandler. Thank you for joining me in this in between time of Christmas, the holidays, and New Year's, and I will see you on the inside.